Welcome back. You've been watching London Eye. I've been in conversation with Prashant Kothari, head of Pictet India Equities. What is your call on valuations now? Because on that, the street is quite divided. Some believe that after the rally that we've had so far, in many pockets, valuations are not justifiable, even if you account for the fact that you might get 15-20% earnings over the next couple of years. Some say earnings will surprise you and therefore maybe valuations are not that expensive. Which camp do you belong to?
It depends on whether you want to take a very short-term view or a long-term view, right? I mean, if you were to take a short-term view, you would say yes, the valuations at whatever 17 times earnings on the next year numbers are really looking quite full, and therefore there is not much valuation upside to the market. But if you were to kind of take a longer view, saying that yes, India is kind of turning around, all these reforms have happened in the last few years, which should start giving their fruits out, and we should see that kind of translating into higher corporate earnings growth, or economic growth and all that, then yes, then even the valuation today would kind of look cheap 3 years down the line. So it depends on what your kind of investment horizon is. Short term, yeah, not much upside. Long term, I would still remain invested.
Which are these pockets which are difficult for you to justify as an investment manager in terms of valuations now?
I would say the industrial space is still tricky. The valuations there are quite rich. I mean, we have seen a lot of downgrades happening, but still the valuations don't make a sense to us on an aggregate basis.
All kinds of industrials, including engineering, EPC kind of play, or you talk about road companies or power companies?
So I'm talking more about the large industrial plays out there, right, which are kind of dependent upon the capex cycle picking up in India, for which we see some signs but very little. So our sense is that the capex cycle will kind of pick up, but very gradually in India, and therefore the valuations that these companies trade at, which are like 30, 40, 50 times earnings, are really not justified. So I think that is one clear area of higher valuation than where it should be.
What about pharmaceuticals? I mean, I know that you own some pharmaceutical companies in your portfolio, but that's gone through a bust kind of cycle over the last 1 year. But how have you approached that as a fund manager?
So fortunately, we kind of cut our holdings at the right time, so we are underweight on the sector and pretty happy about it today. What has happened, as you would be aware, is that FD really came hard upon all these Indian pharma names and really exposed their practices or processes in terms of quality or governance, and which has led to severe pressure for them in terms of their businesses. So several of the facilities are kind of banned from exporting to US. That is one side of the story, and on the second side, FDA has also become more aggressive in kind of giving approvals to new drugs, and which is resulting into big pricing pressure on the generic drugs. So we are suddenly finding that all these companies where the businesses are growing at 20% rate CAGR for many years are suddenly stopped growing in terms of earnings because of these multiple issues. So I think yes, this sector is in kind of a tough phase, which we don't think will kind of go away soon. So this tough phase will last some time, and maybe the valuations will become more cheaper, and that is when it will become interesting again to kind of invest more money.
So it hasn't become interesting after the price crash yet?
Not yet. Maybe individually a couple of stocks have become, but on the whole it is still a pricey sector, I would say.
How are you approaching banks? That's the billion-dollar call. I mean, do you now get into a public sector bank saying most of the dirty linen is out in the public, or do you stay with some of the blue chip HDFC banks? As a fund manager, how do you play the moving parts in the banking space now?
So we have kind of stayed put through these better quality private lenders out there.
Even the corporate lenders or just the retail lenders?
We also have some exposure to the corporate lenders, which have not proven to be as good quality as we thought they were, right? But still, yeah, our exposure has been mostly through the private lenders out there, and which has on the whole worked well for us. There are some signs that the asset quality cycle in India is kind of bottoming out. So if you look at for example, the numbers from State Bank of India recently, and what they're guiding towards, it seems that yes, the NPL formation has kind of peaked out, and most of the problems which are not recognized earlier have been recognized now. and therefore there's obviously thought process out there to say that yes, the earnings should kind of move upwards from now on because most of the hits have been taken. But I think structurally there's still a problem with these public banks. Their governance still needs to kind of improve a lot. They don't have much flexibility on reducing their cost levels, and even in terms of generating other areas of income, which is the fee income side of it, they're clearly lagged behind. So I think on these structural issues, we don't really see them performing. So they might be good trading ideas. I mean, they're trading so cheap at whatever 0.3, 0.4 times book. They might just pop up to 0.4, 0.5, 0.7 times book and really make you good returns. But I don't think these are nice structural stories on which you can just buy today and forget them for next 5 years. I think over the next 5 years, even if there's a valuation pop in this bucket, I think even then the likes of HDFC Bank or Kotak or Indian Bank, as a basket, they'll still kind of outperform over the next 5 years.
How do you approach autos? Because, as we speak, Tata Motors is surprised with its numbers on the way up. There's a lot of glee in India about that stock, which has underperformed for such a long time. What are your positioning in terms of either commercial vehicles or cars or two-wheelers? How are you positioned there?
So that is one stock which has been a big holding for us, and that has worked well. We also have exposure to Motherson Sumi, which is again not really an India auto play because it is a global auto ancillary company. We bought it last year when this Volkswagen trouble was happening and the stock was down a lot. So we thought it's kind of a good opportunity for us to buy into good quality stock, and we did that. So that has become a big core holding for us. Apart from that, I don't really find the rest of the auto space in India very interesting.
You exited Exide as well. Wasn't that holding a while back?
It exited maybe 2 years back.
2 years
so,
back. Okay. Long back.
Yeah. Essentially what happened out there was they were kind of losing market share continuously and not really able to even make margins out of that, and therefore we exited that holding. We lost conviction out there. But I think talking about today, if I look at the auto space, I think most of the story has been kind of played out. We have seen the revival in the CVs, we have seen the revival in the cars. I think all these companies are kind of enjoying good period of volume growth, good period of margins. And yeah, this is a cyclical sector, right? So you have to kind of play it right. You have to sell when these things have played out, and then look forward to the next downturn to really invest again. So I would kind of stay out of that space for now.
If there is a summer correction in emerging markets, including India, looking at how earnings are panning out, would you see it as a buying opportunity, or it depends on the trigger which precipitates that correction?
See, if the trigger is something like Britain exiting EU, right, or if the trigger is deleveraging in China, or if the trigger is US elections, I think these are mostly external events, right? I mean, maybe China thing would have some impact on the commodity prices and therefore some impact on anything related to commodity prices in India. But I think apart from that, these are pretty external events. I would not really worry a lot in those corrections and simply take it as a buying opportunity.
Prashant, pleasure talking to you. Thank you very much for your time today.
Thank you very much.